Good morning, Curtis. How are you?
Doing well. How are you?
Good. So for people that don't know us yet, my name's DeElla, and I'm with Hoberg Homes, North Metro Atlanta Real Estate, and kind of work in this northern arc. You and I are both in Cumming,
Right.
and so that's how we met. We're locals here, and Curtis, you've been here your whole life, right?
My whole life. That's right. Born and raised.
Right. All right, awesome. So Curtis, introduce yourself to everyone and just let them know, why we should listen to you.
Yeah, my name is Curtis, Curtis Eggleston. I work with Southeast Mortgage, and we're based in Duluth, but I work in Cumming. I've been a loan officer now for 5 years. Very knowledgeable about the area, Forsyth County and North, so I can help you with that. I know you, and you're a great agent, and love to help guys get into houses, whether it's first time or second homes. We have a lot of different programs to help.
That's awesome. And one thing that is interesting about your company versus a lot of the big companies is that you have all your processing in-house.
Right.
So,
what that means for a borrower is that when we have processing and underwriting in-house, that means that loan officers can actually go talk to a processor face-to-face, or we can go and talk to an underwriter face-to-face, which is still much more efficient than texting or emailing or Zoom calls or any of that matter. The efficiency of that is remarkable. And I'm seeing loans close in weeks, well, in a week rather than in weeks. Loan I'm working on right now went from application to conditional approval in 5 days.
Wow. Yeah, so that's fast. And we know in this competitive market, being fast is important.
Right. Especially with the market, the way the market's going right now, where when you put in your offer, the name on that loan company for that loan company matters. The speed at which we can close things matters. Financial contingencies are getting shorter and shorter, and we can meet those. And so your offer can stand clear of other offers when you're with a great company.
That's right. And so for those who don't know, what's a financing contingency?
A financial contingency is a period of time that the buyer and the loan company have to complete all the paperwork to get final approval from the loan company that says that you are completely approved to buy the house. Usually that financial contingency stands clear of the appraisal contingency, as you know. So what we want to make sure we have is all of our documents in order. We have that lightning fast processing and underwriting, so that you know that the financial side is clear, that we are ready to go to buy the house. And all we have to think about now is the appraisal and then moving in.
Right. And so how long does a financing contingency typically take?
What I see in most contracts is 2 weeks. What we usually strive for is 10 days.
Okay.
That 10-day mark depends a lot on the buyer, making sure that we have documents in order, that sort of thing. And with Southeast, as I've said before, the speed at which we can move on loans is remarkable. I've worked for several companies, and I've never seen loans move this quickly.
That's great. So, kind of to the meat of what we're talking about today is, how does someone get a loan? Like, what do they need?
We'll just go through the list, the same list that I give every client when I talk to them the first time. Credit score matters. When we get a credit score, those credit scores are matched to certain programs.
Okay.
Credit scores as low as 585 can qualify for an FHA loan. An FHA loan requires 3.5% for a down payment. Credit score of 620 and above qualifies for conventional loans and USDA loans. So the first thing we need to look at is credit score. Do you have any derogatory items on your credit score, on your credit report? After that, it's just a series of documents. We have to have a 2-year work history. We have to have 2 years of tax returns. We have to have proof that you are who you say you are in the form of identification. And we have to have proof that you make the money you say you make in the form of pay stubs and that sort of thing. So a lot of the documents that require are proving the truth of the application. And if you've got those documents in order and you got them in line, I can complete an application in 30 minutes. You can submit your documents to me and we can have it in a processor's hands in less than 2 hours.
Okay. So if someone has a credit score that's not ideal, do you kind of walk them through and look at it with them and help them to clean that up before they're ready to buy a house?
Oh yeah, we've got a department here that we call our rescore department. We have a team of people that is dedicated to helping those customers who have some derogatory items in their credit report or a score that's too low to qualify, and they will walk them through what they need to do to increase those scores.
Right. One thing that a lot of buyers who either haven't bought a home before or maybe it's been a long time, one of the things that I hear concerns about is their debt to income ratio. Can you kind of expand on that a little bit?
Two different debt to income ratios we care about. The back end ratio is your current debt divided into your income. The front end ratio is the potential new house payment added to all those current debts, also divided by your income. And different loan programs have limits as to what that front end DTI can be. We like it to be around 30% for conventional loans. It can go higher for FHA loans. There are some programs with conventional loans that we can also go higher, but 30% is the happy zone. If we can keep it at 30%, that'd be great.
Okay. So if that ratio is too high, then what I understand is that that customer needs to look at what are the most important things to pay off before they're applying for a loan.
Right.
And
I can walk them through that
and
process.
shopping.
Right.
Yeah. And a lot of that debt to income ratio that shows up is usually based on credit card debt and things like that.
Credit card debt, car payments,
Yep.
student loan payments. Most medical payments do not show up as reflective on DTI.
Interesting. Okay. Interesting. So let's say that I'm the borrower and we are working together and I find a house and we get you the contract and the loan process has started. Tell me 3 things that I should never, ever do during the process.
You should never buy anything on credit while you are qualifying for a loan.
But what if they have a 0% interest for 6 months at the furniture store and I'm going to need that furniture for my new house?
It just doesn't matter. Buy it after you close.
Right.
What happens is I will pull your credit the first time. A processor will pull your credit a second time, and then the underwriter will pull your credit a third time. Now, all that combined, there's only one quote hard hit on a credit report, but they'll look at that credit report 3 different times. And if your debt to income ratio changes on that third time because you just couldn't wait to buy that furniture, or you got a really good deal on a boat, then you can lose the house.
Yeah.
Based on a new debt to income ratio.
Yeah, I mean, there are real consequences to doing this. I mean, I was kind of playing it up a little bit, obviously,
Right.
but
Sure.
it's true. And I think that the furniture aspect is one that I hear a lot. I have this conversation with my clients who are getting a loan. It's like, don't charge anything, nothing. But they get excited and they want to go shopping for the new house. And then they think, well, it's 0%. No one's going to notice that, but they do. They do.
And even if you decide not to buy the furniture, if you go to that furniture store and you file a credit application, even if you don't use it, it will still show up as a red flag for our underwriters.
Yeah.
Even if you don't buy the furniture, a simple credit pull will raise a red flag for our underwriters.
Right. Right. And so even if like you're going to, let's say Macy's and you buy a new outfit and they offer you 25% off if you get their credit card, just don't do it when you're, shopping for a house. Just don't do it.
Just wait. I've lost things in the past where people have gone and they're moving from out of state. They've sold their cars where they lived in the other state. They have put an offer in on a home, we're clear to close on the home. And then they go and buy a new car. and the credit process of buying that new car has cost them the house.
Yeah,
Just don't do it. It's not worth it.
just don't do it. So what
I'll
else?
say the other thing, I'm sorry, but I'll say the other thing is make sure you stay current on your present bills. If you can't let anything slide during that month process where you're qualifying to buy that home, because again, those 3 different credit pools are going to show 3 different credit reports. And if you have a derogatory credit on any of those reports, then the process sort of has to start over again.
Right. So 1, don't get any new loans. Don't charge anything.
Nothing.
2 is stay current on what you already owe.
Stay current on what you already owe.
So is there anything else that we should never do during the loan application period? I mean, besides, freak out.
There is a lot of rate shopping going on right now in the mortgage business, which will lend people to go and talk to 4 or 5 or 6 different mortgage companies and find out the different rates. I understand that because interest rates are important. What's important to remember though is if you have your credit pulled 6 different times by 6 different mortgage companies, to the investor side of this, and I don't know if we're talking about investing or not, but when we to the investor side of this and to the original mortgage company, that shows a little bit of a red flag as well, because we don't know simply by looking at the credit report if we're trying to buy 1 house or 2 houses. That has happened. I have seen 2 different mortgages for 2 different homes show up at the same time, and that's a red flag for debt to income ratio as well.
Okay.
So if you're interested in shopping rates, get your credit pulled by one mortgage company, and then call the other mortgage companies and say, my credit score is X. What interest rate can you quote? That's the much more efficient way to do it.
So that's a really, really excellent tip, to get one person to pull your credit score and your history, and then shop it that way, and do it on the phone. Quit filling out every landing page's details when you're shopping. Right. I mean, that's where things are going wrong, because it's actually getting started.
Right. Any loan officer should send you a copy of your own credit report, so you can have it there in front of your face, so that when you talk to another mortgage company, you'll be able to say, my score is X. I have these items on my credit report. What interest rate can you get?
Yeah. And I mean, I think it's smart to shop around a little bit. Several items in my closet, I shopped around for, my car I shopped around for, all that stuff, right? I mean, we're smart. We want to make sure that we're getting the best deal. But, just be safe and careful about how you're shopping. Right.
Yeah. And other things to shop for, if we want to talk about that for a second.
Sure.
A lot of people pay attention to rate, but on a $300,000 loan, 1/8 of a point is about $16 a month. So you should pay attention to rate, but also pay attention to things like closing costs, which is the amount of money that the loan processing cost.
Right.
Pay attention to time. Pay attention to how fast loan companies can get things done. There are a lot more important things than rate, especially if you're talking about 1/8 of a point in one direction or the other, because in the long term, you're not going to notice that $12 that much. But in the short term, you can experience a lot of frustration. You can experience a lot of unexpected costs in closing costs if your loan officer is not up with it.
Right. Well, I want to talk more about that, but I think we should save it for the next time we get together and talk. Sure. Otherwise, it'll be just us rambling on and on forever.
That's right.
Right. I mean, we could talk loans and money all day, but I know we both got jobs to do and loans to close.
That's right.
All right. Well, thank you, Curtis. I really appreciate it. And we'll get this out there on YouTube and Facebook shortly.
All right. Thanks, DeElla. I really appreciate the opportunity.
Thank you.